Step onto the trading floor of modern retail sentiment and you will hear a deafening echo chamber debating the usual suspects of the artificial intelligence and high-performance computing gold rush. Everywhere you look, across YouTube thumbnails, Reddit threads, and financial television segments, millions of retail investors are obsessing over the same handful of overanalyzed semiconductor giants and hyperscale cloud operators. Yet, as ticker KEAL, Keel Infrastructure Corp., formerly known to legacy crypto watchers as Bitfarms before its strategic pivot, corporate rebrand, and U.S. redomiciliation, changes hands around $3.42, the broad financial media is missing the forest for the trees. They continue to slap an outdated, simplistic label on a company that has fundamentally transformed into a premier North American digital infrastructure and energy powerhouse. The market mispricing here stems from a profound cognitive dissonance. Wall Street analysts clinging to old spreadsheet templates still try to value Keel through the volatile, cyclical lens of a pure-play cryptocurrency miner, completely ignoring the structural reality of what matters most in the current technological era: secure, energized real estate with pre-approved grid interconnections. While retail traders jump in and out based on daily crypto asset fluctuations, institutional heavyheads recognize a different physical bottleneck entirely. We are no longer living in an era where software eats the world. We are living in an era where power constraints starve the data center. Consider the physics bottleneck that standard financial media routinely glosses over. You cannot simply wish a multi-gigawatt artificial intelligence data center into existence because you have capital. You need three things that money can rarely buy quickly: raw land, high-voltage grid interconnections, and massive baseload power access. Securing a single grid interconnection queue in major North American power markets now takes years, often bottlenecked by regional transmission organization queues that are completely jammed. Keel sits squarely on a massive pipeline of 2.2 gigawatts of power capacity across strategically positioned data campuses in Pennsylvania, Washington, and Quebec. When you look at campuses like Panther Creek, Sharon, Scrubgrass, Moses Lake, and Sherbrooke, you are not looking at simple warehouse sheds containing basic computer rigs. You are looking at scarce, highly prized digital real estate equipped with brownfield and greenfield power assets that would take competitors half a decade to replicate from scratch. While retail investors chase momentum stocks on Robinhood and argue over short-term moving averages on X, institutional smart money is quietly pricing in the replacement value of scarce megawatts of power. The market is currently mispricing Keel because it views the company through a rear-view mirror of legacy coin generation, failing to see that every single megawatt of secured grid capacity is a golden ticket in the race to power the next generation of artificial intelligence workloads. To truly understand how Keel Infrastructure Corp is trading, you have to look beyond the daily headline noise and examine the mechanical choreography of volume, float, and institutional accumulation. With a market capitalization hovering around $2 billion and over 600 million shares outstanding, KEAL occupies that fascinating volatile sweet spot of the micro to small cap universe where algorithmic trading meets raw retail emotion. Daily trading volumes regularly surge as macroeconomic jitters ranging from shifting Federal Reserve interest rate expectations to regional grid capacity regulations trigger sharp intraday swings. During these macro-driven pullbacks, a predictable psychological drama plays out. Weak-handed retail traders, conditioned by months of algorithmic shakeouts, panic at every minor dip or negative quarterly headline, dumping their shares into the waiting algorithms of institutional accumulators. A recent snapshot of the financial statements reveals why retail traders get unnerved. Trailing revenues sit at roughly $229.3 million, but the company has posted heavy near-term net losses, such as a recent quarterly net loss of $65 million, alongside negative operating cash flows of roughly $52.9 million and free cash flow burn near $96 million. To an untrained retail observer fixated purely on immediate bottom-line profitability, these numbers look terrifying. However, seasoned market veterans understand the playbook of capital-intensive infrastructure plays. Building out multi-gigawatt power campuses, upgrading transformer substations, and securing high-voltage interconnections require immense upfront capital expenditure long before the long-term enterprise leases for high-performance computing or AI workloads fully kick in and reflect on the income statement. While retail investors recoil from negative return on equity metrics and quarterly cash burn, institutional funds with multi-year investment horizons view these periods as textbook accumulation zones. They are systematically absorbing the float, recognizing that the heavy lifting of infrastructure deployment is precisely what creates the economic moat of tomorrow. Before we move on to dismantle the operational guts of the business model, let's pause right here. Where do you stand on Keel? Are you currently holding a position through these volatile consolidation phases, or are you sitting on the sidelines waiting for a deeper macro pullback before entering? Drop your thoughts, your average cost basis, or your watch list strategy in the comments below, and let's debate where this infrastructure play is heading next. To appreciate where Keel Infrastructure Corp is going, we must dismantle the outdated historical framing that haunts its ticker symbol. For years, the company, operating under its former identity, was lazily pigeonholed by Wall Street as a commoditized high-beta Bitcoin miner vulnerable to every minor fluctuation in hash price and network difficulty. That old narrative is dead. While the company still retains legacy digital asset operations that provide foundational cash flow and balance sheet liquidity, its true operational core has undergone a structural metamorphosis into a diversified digital and energy infrastructure landlord. At its operational heart, Keel's business model is built on three inseparable pillars: power, land, and connectivity. The company acquires and develops strategic land parcels tethered directly to robust energy assets, ranging from coal refuse reclamation power sites like Panther Creek and Scrubgrass in Pennsylvania to hydroelectric-rich environments in Quebec and Washington state. By controlling the underlying energy generation or securing direct, low-cost utility interconnects, Keel bypasses the crippling power distribution bottlenecks that are currently choking data center expansions across major metropolitan hubs like Northern Virginia or Silicon Valley. Contrast this modern reality with the old consumer and telecom cycles of the past. Traditional data center operators used to build massive server farms near dense population centers, prioritizing low-latency fiber routes over raw power availability. Today, the physics of artificial intelligence have completely inverted that equation. Massive GPU clusters running continuous large language model training don't care about local consumer latency. They care about relentless, uninterrupted blocks of megawatt-scale power delivered at predictable, low industrial tariffs. Keel's pivot involves repurposing and upgrading its existing footprint, spanning more than 2 gigawatts of total pipeline capacity to host high-density, liquid-cooled computing infrastructure designed specifically for enterprise-grade AI and high-performance computing clients. Furthermore, the company maintains localized engineering and operational expertise, such as its specialized electrical and grid services division in Quebec, giving it a vertically integrated capability to construct, maintain, and scale complex electrical substations and cooling distribution systems internally. This is not a software company burning cash on speculative marketing. This is an industrial real estate and energy toll booth operator. By securing long-term, fixed-rate hosting and lease agreements with high-performance computing tenants, Keel is actively insulating its top-line revenue from the historical volatility of digital asset markets, transitioning instead into a predictable, asset-backed cash flow generator positioned at the exact intersection of energy and artificial intelligence. Looking out across the multi-year horizon, the investment thesis for Keel Infrastructure Corp hinges on its positioning as an indispensable technological gatekeeper in a supply-constrained world. The primary multi-year growth catalyst is the unrelenting exponential demand for artificial intelligence compute capacity colliding head-on with a North American electrical grid that is structurally incapable of expanding fast enough. Major hyperscale cloud providers and AI lab developers are desperately seeking out energized sites where they can plug in thousands of next-generation accelerators without waiting 7 to 10 years for new transmission line approvals. Keel's 2.2 gigawatt pipeline acts as an institutional-grade inventory of ready-to